Ladies and gentlemen, please welcome Bernstein's Richard Clarke.
Good morning, everybody. So when Skift asked me to present here, I thought I'm probably going to be the most unusual presenter here. One, I'm presenting rather than a Q&A. But secondly, I don't work for a travel company. I don't provide a service for a travel company. I've not invented an app for the travel company. I work for a Wall Street finance company. So Bernstein is if you don't know it, is a research house based out of New York with an office in London. And our reputation is really for the quality of our research. We get deep into the industry. I was going to attend this forum anyway because I find this kind of the insight, not just sort of staring at EBITDA, but actually kind of understanding the industry is key to what we do. So I'm going to talk a little bit about share prices today, but I'll try and make it much more interesting than that. I'm sure there is a lot of healthy skepticism around here about the equity markets, capital markets in general, and I share that. For sure, but let's just bear with me for a second and let's just assume that a share price really is indicative of a company's future potential. Then maybe we can look at sort of share prices to sort of look at some of the trends, how things are shaping up. So let's start with the consensus view. You wouldn't be working in the travel industry if you didn't think it was a growth opportunity. I wouldn't be covering the stocks and wouldn't be pushing them if I didn't think it was a growth opportunity. And good news is it is. We actually look over tourism growth versus GDP growth over the long term. It grows about a percentage point higher. And actually, if you look at the most commonly quoted estimates out there, World Tourism Authority Organization suggests 3.3% growth in tourism spend, and the IMF OECD seem to have some consensus that global GDP is going to grow about 3.4%. That looks a little bit weak to me. So I think maybe our most common organization here is maybe understating a little bit how much tourism growth we can get going forward. Yes, it overextends a little bit in the downturns. If you're wondering about some odd jumps, the drop down in 2015 here, the chart is in dollars, so strong dollar sort of pushes some of those charts down. But in general, the trend is that tourism is a growth sector, highly investable, and so that's the positive news. Why do we think this can continue? What do we look at in terms of the drivers of this? So three that we've really been focusing on in our work. Number one is the aging population. Probably most people here will be asked about millennials and the millennial trends. Actually, if you look at UK holiday spend growth, by far the largest growth chunk there is the aging population. They're driving almost all the growth in the UK of outbound spend. You're seeing that in a lot of other markets as well. Secondly, this concept of experiences versus things. 2016, Steve Howard of IKEA said that we were at peak stuff. Peak home furnishings, suggesting that we would spend more and more stuff on experiences. We can back that up with data as well, that in general over the last few years people are spending more and more money on experiences, less money on things. That should continue over time. And then last one, globalization can sometimes be considered a bit of a dirty word, but what I mean here is that increasingly, we're getting more and more destinations opening up, more flights to new destinations, and more markets, people coming from those destinations as well. An interesting stat here, if you look at the Chinese millennial spends 30% of their income on travel and leisure. That compares to 11% for a US millennial. The difference is intergenerational wealth transfers. If you're interested in the nitty-gritty, most Chinese millennials don't have mortgages. They've just inherited houses. So they've got plenty of disposable income, and they can just pass that on to travel. So that is going to be a key growth number, and I'll come on a little bit to China as a key point going forward. So share prices, I said I was going to talk about it. For a long time, I could take this chart back further. It was fairly clear how you invested in travel. You bought the disruptor. There's an awful lot of sense in that in all industries. You buy the disruption company, the world changes. You have different cost structures, different capital structures, and you need one that's more suited for the world ahead. And that worked. You buy Expedia, you buy Ryanair rather than Lufthansa and TUI, and that was true through to 2017 as a trend of how you would play this game. Something's changed. In the last year, we've seen a big change. Some of these are just 5 examples, but you can see here that the incumbents, the guys that own the content, we had Peter Frankhauser up here earlier using the phrase "content is king," they've begun to turn it around. You know, these companies are beginning to innovate. They're beginning to win back the business, beginning to win back the direct travel, and the share price trends have changed. So there's a new paradigm here. You don't just buy the disruptor, or perhaps we're seeing the disruptors being disrupted by the next wave, but in general, some of these companies are beginning to fight back. And I'm going to talk about four trends here today that we've been looking at in our research that sort of influences how we see sort of share prices evolving going forward. So platform versus content. I could be in any industry forum in the world about any industry and talk about that theme. China opportunity, this wave of hotel openings and what's happening with the hotel market worldwide. And then package tourism. Again, thank you to Peter if he's still here. He used the word dinosaur. I had it in my presentation already. Is it the dinosaur package tourism? Can it fight back? So number one, platforms. So as I showed you in the slide a couple of pages back, you know, Expedia has begun to slow down. The revenues have begun to slow down. What do we see there? Well, interestingly enough, probably if I stood on the stage about 5-10 years ago, you know, I might have been able to use the phrase the brand is dead. The democratization of booking. Every hotel has got equal share of voice by using the OTAs to get there. But that does not seem to be panning out right now. About 90 to 95%, depending on the region, of hotels being built in the world are branded. And about 60% of those are just within 4 brand families: Marriott, who we had up earlier, Hilton, Accor, and IHG, Intercontinental Hotel Group. Why is that? It's because actually hotels in general have given up an enormous amount of their distribution to the online travel agents. It used to be just filling the Sunday nights and getting them the extra occupancy there. And increasingly what they've done is they're filling up every night with the OTAs. And that's why I've used the title here. Platforms are the victims of their own success in a way, that as they've taken more and more of the distribution, hotels are having to find ways to distribute away from them and get away from that platform. And right now, the best way to do that is to go to one of the chain hotels, one of the big chains. They'll help you avoid the commissions in the best way. They've got the collective bargaining power, and they've got their own commission-free distribution channels. And I said I could use this theme about any platform in the world, about any industry in the world, about whether you buy the content or whether you buy the platform. I mean, look at what Netflix is doing. It's investing $12 billion in content. Why is that? Because it realized that Disney could come off its content, it come off its platform at any moment. And when it realized that, it realized it needed content. Amazon's investing $5 billion. Even Facebook, which is not famously a content business, is investing over $1 billion in content. To some extent, the OTAs are a little bit behind here, and this is why, you know, we feel like they're beginning to lose out. The brands that own the content are beginning to win through. China. Coming on to China, look, at Bernstein, we've written a lot of work about China. It's always probably one of the top topics we talk about. We think the China travel opportunity is not only the largest opportunity in travel, it's the largest single opportunity in the world. $400 billion of additional spend is going to come out of China. Of travel spend is going to come out of China by 2025. That's a huge amount. Now, again, a change in paradigm here. Historically, you want to invest in China. You buy the local companies. They understand the local market, and a lot of the focus in China has been around the growing middle class and finding the companies. Jinjiang is a great operator of mid-scale hotels. And you buy that content that knows the local market. Again, it's shifted round. The likes of Hilton, Accor are beginning to win through. Why is that? This is what is not understood. Is yes, the middle class is growing in China at about 5% a year. The premium class, the premium spending class, which is about 65 million people, is growing at about 10% a year. The super premium, which is the guys that really consume high premium brands, is growing at 22% a year. You're seeing a much faster growth at the premium end of the Chinese segment. And that means there is a more and more demand for luxury hotels, luxury travel brands in China. Who are the best operators? Who are the best brands associated with luxury? It is the Western hotel brands, the Waldorf Astorias, Raffles, part of Accor, St. Regis, Ritz-Carlton, etc. That's where the growth is actually coming, and that's why you've seen this turnaround we see in the share price. And you only need to look on TripAdvisor. If you look in London, The top branded hotel on TripAdvisor is probably number 10, somewhere around there. If you go and look in Shanghai, the top 5 are all Western branded hotels. There is much more popularity of those Western brands in China actually than there is in Europe and the US, and that's why we're positive on that trend going forward. Third one, I think anyone that follows the hotel market probably knows this left-hand chart pretty well, that post the financial crisis, people stopped building hotels. Finance dried up. If you look at the US market in 2011, 2012, we only had 0.5% of net room growth in the US, and we've begun to see a pretty rapid inflection point over the last couple of years. I find much less well known is this right-hand chart. That what seems to have happened is a collapse of pricing power in the hotel market. If you look historically, an amazing correlation between the occupancy of hotels and their ability to increase prices. So historically, before the last downturn, 2008, 2009, prices in the US market were going up by 6-7%, entirely appropriate for hotels that were nearly full. I know 63% doesn't sound like nearly full, but you guys will know the hotel market better than I do. That means your Saturdays in July probably pretty much are full. Right now, we've seen that trend broken, and this is one of the interesting trends we're tracking, because what happens when occupancy begins to level off now, and you can't get those occupancy gains in hotels, what happens to the pricing? We simply don't know. Why do we think that this gap has opened up between occupancy and pricing? I think there's a number of things. One, we've got a lot more price transparency in the world. People are booking later and later for their hotels. People are using the OTAs and using apps. 70% of same-day hotel bookings are now done on a smartphone. I think I learned that stat at last year's Skift Forum, so maybe someone will update me that that's gone up even further this year. And so you've got that extra price transparency. And this is where we see Airbnb coming in. The best evidence that Airbnb is not eating the hotel market alive is the fact that we are at record occupancy in the hotel market. But where is it having an effect? It's having an effect on pricing. Your willingness to pay 8% more, which is maybe what you should be paying than last year, is influenced by the fact that there's now this extra supply, this extra option. And particularly when there's a major event in town, like the Super Bowl, the FA Cup final, or the Skift European Forum, and then suddenly a huge shortage of hotel rooms, and they used to be able to gouge the prices, now they are no longer able to do that. So you've seen that gap open up. It's an interesting trend. I don't think many people have broken hotel revenue growth between that. They're just focused on the fact that revenue growth is pretty strong right now. And then the last trend I want to talk about is package tourism. We had Peter up here earlier, I spend my days talking to multi-millionaire New York hedge fund managers and trying to tell them that package tourism is a real growth industry, is a tough sell. They're not particularly interested in sitting a plane down to a beach holiday when they've got their own private jets. And it's the same when you're trying to suggest that cruise industry. It's always a tough sell. And in general, from 2013 to 2014, this influenced TUI's and Thomas Cook's share price. Investors did not believe that this was anything other than an industry that was both disruptable and archaic. Why would people want to go on this? And if you look on the chart on the right-hand side, you can see there was some evidence of that. As you saw the growth of the online travel agents, the growth of low-cost flying, it was much easier to put packages together yourself. And you saw a big loss of share of the package tourism industry over that decade. But they've begun to fight back. And the best performing shares in my coverage for the last year have been the package tourism businesses. What do? They actually fit in quite well with the sort of current zeitgeist of this anxiety of travelers, actually traveling with a trusted name. You ask someone who got off the plane at Tunisia when the first plane went back, why were you happy to go back to Tunisia? They would say it's because Thomas Cook has gone back. And it's because they're providing that trustworthy name. It actually fits in much better with the current trends in travel than most people expect it to. And you've seen, even for the last 5 years, the package growth has outpaced total travel growth across the industry. And that has only really begun to be realized in the last year. And we're beginning to see, and Peter did a great job earlier, of talking about some of the things that Thomas Cook's doing and saying that TUI was doing similar efforts to win that back. So overall, maybe to conclude, in terms of investment conclusion, which is what I'm used to doing at the end, branded hotel growth looks very strong in China. There's some trends to buy into there. They do love the brands there. Go on to booking.com and look at the top priced hotels in Shanghai. Most of them are Western brands. Go on to TripAdvisor, similar trend. And package tourism. These stocks suffered for a long period. They're beginning to come back. This is something we actually think fits much better into current travel trends than most people realize. And with that, thank you very much.